Hello and welcome to the Deep Dive. We're digging into this really interesting stack of sources you shared with us. They look almost exactly like the building blocks for one of those AI-generated market news videos.
Yeah, the structure is quite clear, isn't it? It gives us a great snapshot market summary, specific currencies like the yen, US stocks, macro stuff. Perfect for getting a handle on late October, early November 2025.
Exactly. So our goal today is to pull out the really essential nuggets, the high-impact financial and geopolitical takeaways to get you up to speed fast.
Sounds good. Let's do it.
Okay, but before we dive into the actual data, we do need to touch on that unique format you mentioned. Since the underlying content seems to be put together by an AI tool, there's a specific disclaimer we need to run through first.
Right, yes. So based on these prepared resources, this content is generated by an AI tool. The original source materials are listed where the summary came from.
Okay.
And importantly, because it's AI generated, there might be, occasional errors, names, maybe pronunciation, that kind of thing.
And the big one.
The big one. This is absolutely not investment or trading advice. Please make all your investment decisions based on your own research and discretion.
Got it. Okay, with that important context out of the way, let's jump right into currencies. Because, wow, the action in USD/JPY looks intense. It's all about the Fed versus the Bank of Japan, right?
Oh, absolutely. That policy divergence is the main engine here. And what's really striking is just how big the bets are. You've got hedge funds piled in. Betting the yen weakens further. They're looking at 158, maybe even 160 yen to the dollar by year end.
160. That's a big number.
It is. And look at the options market calls for dollar strength, so betting on a weaker yen, are trading at 6 times the volume of puts. That's huge. We're talking over $150 million in notional value just on that one-way bet.
Wow. So everyone's on one side of the boat. Doesn't that make the trade a bit dangerous if the BOJ suddenly changes its tune?
It definitely raises the stakes, and the market's aware of that potential fragility. You see Nomura, for instance, forecasting 157 in a month, then pushing towards that 158, 160 range by the end of the year.
And where are we now, roughly?
Well, the source material puts the spot rate around 153.65 to 154.17 as of late October, Tokyo time. So still a way to go to hit those targets.
Okay. And the policy backdrop hasn't changed?
Not fundamentally.
Yeah.
The BOJ held rates like expected. And the market's basically pushed out expectations for the next hike way into like March or April 2026. Meanwhile, the Fed, they cut rates recently, but Chairman Powell was careful. He basically said, don't automatically assume another cut's coming in December. No guarantees.
You mentioned intervention risk. I saw something in the notes about specific options traders are using near that 160 level. RKO options? That sounds pretty technical.
Yeah, reverse knockout options. It's kind of a niche product, but basically using them right around the 160 level tells you where traders think the Bank of Japan might, draw the line.
So it's like betting it gets close to 160, but maybe not through it because the central bank steps in.
Exactly. It signals that 160 is seen as this sort of unofficial psychological intervention point. They're hedging against, or maybe even betting on, the BOJ defending that level.
Fascinating. Okay, let's pivot across the globe to the Eurozone. We've got some inflation data. What's the main story coming out of the ECB?
Well, it's a bit of a mixed bag, really. The headline inflation number year over year for October dropped a bit to 2.1%. That's good news. It's getting closer to the ECB's 2% target.
Okay, but there's always a but, isn't there?
There usually is. The but here is that core inflation, which strips out volatile stuff like energy and food, didn't budge, still stuck at 2.4%. And maybe more importantly, service price inflation actually ticked up to 3.4%.
Ooh, service inflation accelerating? That's not what they want to see.
No, definitely not. It suggests that even though some global price pressures are easing, the domestic stuff, wages, service costs, that's proving sticky, it complicates things for the ECB.
So how does that square with comments from ECB officials? I think Kocher, Mueller, Kazaks were mentioned, saying the current interest rate level is in a good position. Does the sticky service inflation worry them?
I think it explains their cautious stance. They see the current rates as doing their job on headline inflation eventually, but the sticky services part means they can't declare victory or signal rate cuts anytime soon.
Makes sense.
Yeah, and they specifically mentioned, don't put too much weight on economic forecasts way out in 2028 because there's just too much uncertainty right now. They're playing it careful.
Okay, and just quickly before we leave Europe, Nomura Asset Management was flagged as liking UK gilts. Why the preference for the pound over the euro right now?
Yeah, they pointed to the 10-year gilt yield around 4.4%, looking more attractive than, say, German bunds or French OATs.
Okay.
The thinking seems to be based on a couple of things. Potential rate cuts from the Bank of England down the line, maybe sooner or deeper than the ECB, and also some optimism about fiscal improvements expected in the upcoming November budget.
Got it. Okay, shifting gears now to the U.S. equity market. Indices have looked strong, S&P 500, NASDAQ, Dow futures pointing up recently. But the sources raise a really critical point about the depth of this rally, especially the AI part.
Yeah, this is crucial. The headline number looks amazing, right? S&P 500 up 18% since a recent election. But if you take out just those handful of mega cap AI boom stocks.
Big tech names.
Exactly, your Nvidias, etc. If you strip them out, that 18% gain drops to just 5%.
Wow, only 5%. That's stark.
It really is. It shows how incredibly concentrated this rally has been. It all hinges on a few giants, particularly Nvidia, which the notes called the epicenter, now apparently a $5 trillion company. It means if those top, say, 5 stocks wobble, the whole market feels it.
And we see that in the individual stock moves mentioned too, right? Big pops for Amazon, Tesla, Netflix.
Yeah.
But then Meta and Apple were down slightly.
Precisely. It's not broad-based strength, which makes the next story even more telling. It really highlights a potential blind spot on Wall Street. Tell us about Fiserv.
Yes, Fiserv, the payments company. Took a massive hit, didn't it?
Massive. Plunged 44% in late October. Wiped out something like $30 billion in market value. The trigger was poor performance, apparently centered around their Clover point-of-sale system, which seems to have been maybe overpriced or underperforming.
Okay, a big miss.
Yeah.
But what's the really eyebrow-raising part?
The analyst coverage. Get this. Out of all the Wall Street analysts covering Fiserv, only one had a sell rating before the collapse. Just one. A 26-year-old analyst from Rothschild & Co. Redburn.
One analyst out of how many? That's incredible.
It really exposes that institutional optimism bias, doesn't it? The data point mentioned alongside this was that overall, only about 5% of analyst ratings on S&P 500 stocks are sell.
Only 5%.
Yeah. It suggests maybe that one of the biggest risks for you isn't always the obvious geopolitical headline, but perhaps the information you aren't getting because of, well, maybe complacency or groupthink among analysts. The institutional cheerleading can be a problem.
That's a really powerful point. And it leads perfectly into thinking about market sentiment, right? Measuring the emotion. The CNN Fear and Greed Index was mentioned. Can you briefly explain the idea behind tracking things like put-call ratios or volatility? What's the goal?
The goal is basically to take the market's emotional temperature. Is everyone euphoric and greedy, ignoring risks? Or is everyone terrified and panicking, maybe creating buying opportunities? The index uses 7 different indicators, things like market momentum, junk bond demand, the VIX volatility index, put-call ratios compares them to their historical norms.
To see if things are stretched.
Exactly, to see if behavior is getting extreme. So for instance, if the VIX is super low and everyone's piling into risky junk bonds, the index swings towards extreme greed. It's meant to be a behavioral counterweight, a reality check against that potential optimism bias we just saw with Fiserv.
Makes sense. A check on the narrative. Okay, let's broaden out again to the geopolitical landscape. The U.S. federal government shutdown, still ongoing.
Yep, still ongoing. Into its 5th week as of early November, according to the sources.
And what are the immediate impacts we're seeing?
Well, first, the practical stuff. Key economic data releases are getting delayed, things like job openings reports, which markets watch closely. But the really big looming risk seems to be transport.
Transport, how so?
Vice President Vance apparently warned that if this shutdown drags on through the Thanksgiving holiday period, it could be catastrophic for air traffic.
Catastrophic.
Yeah.
Strong word.
Yeah. He cited 13,000 air traffic controllers and 50,000 TSA agents who are currently working without pay. The concern is that staffing shortages will become severe, leading to major delays, especially at big hubs like JFK and Dallas-Fort Worth.
Wow. That really brings home the real-world consequences. And it ties into some of the weaker economic data we saw too, doesn't it? Like that ISM manufacturing employment number.
Exactly. That came in quite weak, 45.3, clearly signaling contraction in manufacturing jobs. So you have these macro risks hitting the real economy quite directly, which I suppose makes the bit of good news on the U.S.-China front potentially more significant.
Ah, yes, the APEC meetings and the trade truce.
Yeah.
What was the outcome there?
It looks like a genuine, albeit maybe temporary de-escalation. The White House announced some concrete agreements. China agreed to suspend planned additional export controls on some key rare earth metals, things like graphite, gallium, germanium.
Okay, those are critical for tech and EVs.
Very critical. And China also agreed to halt investigations into U.S. chip companies like NVIDIA and Qualcomm.
Okay, so China offered concessions. What did the U.S. give in return?
The U.S. extended the existing trade truce, essentially pausing new tariffs, and importantly, rolled back the expansion of its entity list rules.
Rolling back the expansion of the entity list.
Yeah.
What does that mean in practice for chip companies?
Well, the entity list restricts U.S. tech sales to specific Chinese firms. So rolling back a planned expansion means fewer Chinese companies will be added to that restricted list, at least for now. It eases the pressure slightly, creates a bit more breathing room for trade.
But it's not a full reset.
Oh, definitely not. You still had Treasury Secretary Bessent making it clear afterwards that allies need to continue to de-risk with China. So the underlying strategic tension is still very much there. This feels more like a tactical pause than a strategic shift.
Got it. A temporary cooling. Okay, one more specific corporate story before we look ahead. This one out of Japan. JA Mitsui Lease.
Yeah, an interesting example of cross-border risk. JA Mitsui Lease had to book a pretty large reserve provision, 18.9 billion yen. It was triggered by the bankruptcy, the Chapter 11 filing, of a U.S. auto parts maker called First Brands Group.
Okay, how were they connected?
JA Mitsui Lease held a lot of receivables from First Brands, about $1.43 billion worth. Now, technically, these receivables were secured by counterparties like Amazon, GM, and Ford, but the bankruptcy still forced the provision. It just highlights how interconnected things are and how distress in one sector, even in another country, can ripple through unexpected places.
Right. Counterparty risk is always lurking. Okay, let's wrap things up by looking at the upcoming economic calendar. The sources mentioned using investing.com data focused on U.S. time, GMT Day 5. What should we be watching?
Well, we already got some key manufacturing data points for early November. The S&P Global Manufacturing PMI came in a bit better than expected, 52.2 versus a forecast of 52.0.
Okay, slightly positive.
But the ISM Manufacturing PMI was still below 50 at 49.2, though slightly better than forecast. The ISM Prices Paid component, though, that was hot 62.4, higher than expected. Shows inflation pressures persisting in the manufacturing supply chain.
Now, we mentioned the weak ISM employment number earlier. Anything else coming up immediately?
The main things to watch on November 3rd, according to the inputs, were Fed speakers. FOMC member Daly was scheduled to speak around noon U.S. time, and then Fed Governor Cook later at 2:00 p.m. U.S. time.
So markets would be hanging on every word there for clues about the December Fed meeting.
Absolutely. Parsing that Fed speak for any hint about whether that recent rate cut was a one-off or if the door is still open for another cut before year-end.
Okay, so let's quickly summarize the pressure points we've hit. We've got the yen under serious pressure, with massive bets pointing towards a 160, but also signaling intervention risk there. We have a U.S. stock market rally that looks strong on the surface, but is actually incredibly narrow, dependent on just a few AI names. And then there's the very real, potentially catastrophic risk to travel from this ongoing government shutdown.
Right. And if you layer on top of that the story about Pfizer and that startlingly low number of sell ratings across Wall Street, that mere 5%, it really does lead to a final, maybe provocative thought for you to consider.
Okay, let's hear it.
Given how concentrated the market rally is, how reliant we are on just a handful of stocks, and how seemingly reluctant analysts are to offer genuinely critical perspectives, is it possible that the biggest risk right now isn't the geopolitical stuff we all watch constantly, but rather the risk embedded in the consensus itself, the risk of what we aren't hearing because of that overwhelming institutional optimism?
Is the lack of diverse viewpoints the biggest danger? That's definitely something to chew on, a really thought-provoking way to end this. We certainly hope this deep dive gave you the key insights you were looking for today. Keep exploring, keep questioning, and we'll see you for the next one.